China's economy surprised again in the September quarter, this time to the upside. Justifying authorities' policy strength through 2023, momentum snapped back in the September quarter. GDP growth accelerating from a downwardly revised 0.5% in the June quarter to 1.3%. The result leaves year-to-date growth at 5.2%, safely above the full-year target of 5%. The monthly activity data is our best guide to momentum in key sectors and the risks China's economy faces into 2024. Retail sales are constructive, annual growth accelerating from a recent low of 2.5% in July to 5.5% at September. Underlying this result is strength in catering services, up almost 14% over the year to September. Discretionary spending on durable goods remains weak, however, and the urban-rural split suggests households in major cities are financing higher spending on services by limiting or delaying discretionary spending on goods. The imbalance between services and discretionary goods consumption is also likely a consequence of persistent weakness in housing construction. While the year-to-date decline in property investment has stabilised, activity is currently close to 20% below peak levels, and so therefore is associated demand for home appliances, furniture and fixings. Established households are also much less likely to upgrade their home or car while their wealth is going backwards. Thankfully, recent deposit data signals an abating of consumer anxiety over the outlook, with precautionary savings materially reduced even as the PMIs point to soft and uneven job prospects across the economy. If employment opportunities grow, the next step should be increased demand for housing, which authorities could help along by providing additional policy support. On investment more broadly, authorities' focus on productivity and efficiency is clear. Key subcategories of high-tech investment continue to grow at between 10 and 40%, even as their combined size nears that of property investment. Utilities investment is also up 25% year-to-date, and other infrastructure around 6%. Unlike property, these subcategories of investment are income and efficiency producing. Hence, their completion is just the start of their contribution to the economy. If China's success with trade continues, continued robust growth can easily be justified. For this outlook to translate into sustainable job and wealth creation and healthy growth in consumption, however, gains for high-tech manufacturing and infrastructure must be recycled back into the domestic economy, particularly the service sector. A housing uptrend, meanwhile, can only occur as new households form and existing households become wealthier and confident enough to trade up. Overall, Q3 GDP and the September monthly data imply current momentum in China's economy is stronger than the market had anticipated, and there is no obvious reason why it will fail immediately. But risks around the consumer remain, particularly for young workers. So, while we have revised up our 2023 forecast from 5% to 5.3%, we have also lowered our 2024 forecast from 5.5% to 5.3%, after which a deceleration to around 5% is still likely in 2025. Looking to the long term, given its existing capacity and willingness to invest, China has a great opportunity to benefit from the global green transition and the developing world's need for quality technology at an affordable price. Their logistic capabilities and trade linkages are also second to none. That said, to meet their development goals, there must be a continued focus on improving the economy's financial health and strengthening all households' confidence and wealth. We'll see you next time.